Good morning, everyone. You are watching live Daily Market Outlook for Wednesday, 29th of February 2012, the last day of the current month. The top stories and top events of today is actually the top event is today's European Central Bank action, where the ECB is expected to pump approximately €500 billion into the Eurozone troubled financial system. The markets were backed with these expectations in the past 2 days, with the risk appetite seems to be back in play after initially reducing the speed, and we have witnessed some mild corrections on the majors, especially on the euro and sterling, that are back now to strength, and sterling even breaking some significant levels, while also gold is heading higher, and the break will be above the previous highs, now opening a way for further extension higher. Today's action is expectations actually go from 250 to 750 billion euros, while some median expectation comes around 500 billion. That would be the most realistic, as the Central Bank of Eurozone is expected today to pump this amount into the financial system that is in troubles. And this is the second time in as many months, actually, in what it hopes will be the last such operation to fight the Eurozone crisis. The banks can stock up on as much of the ultra cheap 3-year loans as they like. At the second of the twin funding operation deployed the ECB unveiled last year to dampen tensions in the Eurozone bond market that threatened to tear the bloc apart. The president of European Central Bank, Mario Draghi, whose native Italy was at the epicenter of the crisis when the bank announced the measure last year, said after the first of the LTRO operations that a major credit crunch had been averted. Banks used much of the 489 billion euros they borrowed at the first LTRO to cover maturing debt. Draghi also urged them to lend out the funds they tap on at Wednesday's operation to household and businesses, helping strengthen economic growth. The LTRO, the longer-term refinancing operations, have sucked much of the heat out of the Eurozone crisis and given governments time to work out sustainable budget and growth policies for affected countries on the periphery of the bloc. The financial markets are, of course, watching carefully the progress and acting accordingly. Apart from this, today we have a quite busy day, a number of events already released and due to be released today. Just highlights of Asian sessions releases. Japanese preliminary industrial production monthly release came at 2%, better than 1.6% forecast for today, but below the previous month release of 3.8%. From UK GfK consumer confidence came the same level of the previous month release, minus 29, worse than forecasted, minus 27. The Australian retail sales came along with expectations at 0.3%, better than previous release at minus 0.1%. Japanese housing starts improving, minus 1.1% is today's release compared to minus 7.3 of the previous month release, and minus 3.4% forecast for today. Europe starts with German import prices released at 7 o'clock GMT today. Quite a strong raise by 1.3% is today's reading compared to 0.5% raise and 0.3% of the previous month. French consumer spending dropped by minus 0.4% versus previous month at minus 0.2%, and the consensus for today at plus 0.3%. Swiss economic barometer released a couple of minutes ago. It came at minus 0.12, versus minus 0.15 of the previous month, and minus 0.11 this consensus for today. Later at 8:55 GMT's German unemployment change improvement minus 5,000 is forecasted for today, compared to the disappointing minus 34,000 in the previous month release. Net lending to individuals from UK due at 9:30. 0.9 billion pounds is today's forecast, compares to 0.4% billion of the previous month release. Mortgage approvals from UK at the same time increase to 54,000 is forecasted for today, compared to 53,000 on the previous release. Eurozone CPI is due at 10 o'clock GMT, 2.7, unchanged from the previous releases. Today's forecast, while core CPI yearly is expected to go up to 1.8% compared to 1.6% of the previous release. The LTRO operation is due to be released at 10:15, pardon, the GMT, and when we might see some stronger market actions, as actually the markets are awaiting this. From US at 13:30 preliminary GDP quarterly release, 2.8% unchanged from the previous fourth quarter, and the preliminary GDP price index quarterly 0.4%, again unchanged from the previous month. 14:45 GMT is Chicago PMI, 61.6 is today's forecast, compared to 60.2. Also at 15:30 GMT we have crude oil inventories that are expected to raise for the second week. 1.4 million barrels build is forecasted today, compared to build of 1.6 million barrels of the previous week. Meantime, the Fed Chairman Bernanke is due to testify at 1500 GMT. That was a brief look from the fundamentals. Now we are going to the technicals and see the latest movements in the markets. The euro, after hitting a correction low at 133.65, again the strength, and fully reversed the recent mild correction of 134.85, as 134.85 was seen in the early hours this morning. Currently the pair is in a slight corrective pullback down to 134.50 zone. The break below hourly 20 days moving average might weaken the immediate tone. However, holding above 134 and 133.88, and strong support at 133.65, 133.56, 40 zone keeps the wider picture as strength and the uptrend intact. 134.17 is 20 days exponential moving average on the 4-hour chart that maintains the recent uptrend from middle of February, and keeps the upside in focus. Lift above 134.85 is to resume the uptrend of 16th of January, higher low at 129.73, and open upside the 135.00, and static resistance at 135.47, high of 2nd of December 2011. The daily studies are more into positive tone, as holding above their midlines, and current attempt crossing 20 days above 90 days is to signal further, as the 20 days is the fastest moving average on this chart, and to signal a further possible further strength. It's important to break this congestion at 134.85 in order to resume higher on the upside to 135.47 and 135.67. 22nd of November 2011 highs will come in focus. Ahead of 136 zone, 136.14 is the 18th of November 2011 high, and 136.26 is Fibonacci 61.8%, pardon, of the down move from 142.46 down to 126.22. Cable is also in the strong path after yesterday's renewed attempt lower found support again at 159 zone. 157.99 was the low of late hours of yesterday afternoon, and yesterday's morning, actually 27th of February evening at 158.09. That offered good support for the pair to break higher. Better shown on the daily chart, where we see the break of critical barrier at 159 and 159.26 as the pair first time briefly broke above 200 days moving average, last time seen in 31st of October 2011. Also clearance of previous peak at 159.26. My signal now, fresh strength ahead at the end of the current range trading that lasted from the beginning of February 2012, and that was limited within 156.50 and 159 range. Break higher to open levels at 159.89, which marks the 50% Fibonacci retracement of the broader down move from 167.45 24th of April 2011 yearly high, and also to open 160.00 as a round figure support, and 160.90 next level, the 14th of December 2014, pardon, of November 2011 high. Near term on the downside, immediate support, dynamic support 159 is also the 20 days exponential moving average ahead of levels at 158.75. The most important level is 158 zone, and holding above here would keep, this is also the channel support, so keeping above this level maintains the short-term bullish structure and keeps the upside in focus. Loss of 158 might risk reversal back to the recent range, as this would mark between 38 and close to 50% half of the reversal, half of the way of 156.47 to 159.37 ascend, and it might risk further ranging of the pair, while firm break and today's close above 159.00, 159.26 is to confirm the positive structure and possibly open way for a fresh extension higher. Dollar yen remains stuck currently after remains under pressure and stuck below 81.00 after a pullback of 27th of February, fresh high at 81.65. Fresh 9-month high, dipped as low as 80.00 where the temporary support was found. However, the recovery attempt so far faces strong barriers of the hourly Ichimoku clouds at 80.77 and 80.68, where the base of the cloud acting as resistance and keeping the price action blocked at this point. The hourly studies are also holding slightly below their midlines, signaling that possible further weakness is ahead and keeps the downside vulnerable. As long as 80.00 holds, there is a possibility of further fresh strength and possible expansion towards through 80.68, 80.77 towards our next significant barrier at 81.00, while loss of 80.00 would risk a further reversal and possible test of our next strong supports at 79.50 and 79.00 post-intervention in October 2011 peaks. A break above 81.00 is required to refocus 81.65 and the open way higher towards 82 and 82.21 highs of May 2011. Dollar Swiss also remains under pressure as the latest recovery of 89.29 high of low of 24th of February 2012 was capped by 90.00, our initial resistance, and so far the pair is in descending mode, hitting levels just ahead of 89.29. The pressure remains at the downside as long as 90.00 holds the as initial barrier holds. The upside with the break lower to expose the two open way for further extension of the broader downtrend of 95.73 high of January 2012, and the target on the downside would be very significant level of around 87.65, where is 87.70, where is 200 days moving average, and Fibonacci expansion of 61.8. That would be the next target in case of break lower. The daily studies are also in the negative territory, and see potential of further extension higher. Any bounce above 90.00 is still seen corrective, as long as a strong resistance zone at 90.80 and 91.00 holds the upside, and likely would be just a good selling opportunity as the wider picture still keeps the bears fully in play. Crude oil is in past 3 days in the downtrend of 109.92, peak of last Friday, with fresh leg lower and a strong slide seen late yesterday, dipping from 108.26 down to 106.29, with 106.21 overnight session low, seen lowest so far in the past 1 week. The studies are negative on the lower time frames. Hourly studies are still in the negative mode, holding below their midlines, with the suggestion of further extension lower, with the 20 days moving average currently at 107.18, capping immediate upside action in the near term. 4-hour structure is weakening as MACD and the momentum are breaking below their midlines, and suggesting a further extension lower, with the 55 days moving average at 106, offering dynamic support, along with the 105.50 previous higher low of 23rd of February. For now, only a regain of levels close to 109 would be is actually required to ease the current bear pressure and avert immediate risk of further extension lower, as currently the oil price is attempting to break below the recent short-term bull channel. This would signal further retracement of the latest rally from 95.43 2nd of February low that bottomed at 109.92 on the 24th of February. And the last is gold, doing very well so far after yesterday's rally through a previous high in the 1787, extending gains so far to 1790 zone, ahead of current reversal lower. The hourly studies are still in the positive territory, though a bit stretched, overbought actually conditions. See potential as it's already developing the correction lower. 1782 previous highs and the lows of overnight are offering initial support, while dips should be capped, should be limited somewhere above 1770, where is also 55 days hourly moving average, in order to keep the current strong near-term structure of 1761.50 low of 27th of February. The wider picture sees break of this current correction, break above the high of 1787 as the next step towards our targets at 1795 and 1802 highs of 14th and 8th of November 2011, to resume broader recovery of 1522 and 1705 higher platform, which is a short-term very strong support, and holding above this level would keep the larger time frames bulls firmly in play. Good luck.